Let's start off with a South African picture, because we saw a bit of data coming through. We are now in a deficit, a trade deficit, 6.7 billion rand, and that was mostly due to the fact that we increased our oil imports. Were you feeling a bit concerned about the fact that we went into deficit last month?
Very much so, because domestic demand is still quite subdued, and you can see this with the credit numbers, the retail sales, etc. And one would like to see us not just flirting with positives and negatives, which we have done over the past few months. One would actually want to see a strong positive trade balance going into the recovery, not something that's
but surely
neutral.
This is a very volatile number. I mean, last month we had a 3.5 billion rand surplus.
No, exactly. It is very volatile, but one would expect at this stage to start seeing more consistent surpluses, given that our economy is reasonably subdued. Because when the economy picks up, the imports will pick up, and we're back into what looks like a structural deficit problem, and this is why we, be concerned that it is a
imports
deficit.
rose 22%, and we saw that exports declined by 3.2%. So a little bit disappointing on that front as well.
Very disappointing. Certain of our exports have in fact improved in price. Gold and platinum being two key exports. We should have seen a better number.
Okay, credit extension numbers also very disappointing, contracting for the first time since 1966, 0.4%, and that's from a previous reading of 4%.
Well,
1.5% rather.
It's interesting, because credit has effectively collapsed. Being static from one year to the next is actually a very interesting setup. Not entirely negative. What it does suggest that the consumers are still under pressure, that the banks still are, maybe their lending criteria is too tight, or they're not finding enough creditworthy borrowers, but it does mean that your household balance sheets are in fact being reset, and that's one of the things that recession should be doing. If it's one positive thing about a recession, is that people's balance sheets should improve ultimately when they emerge from a recession. And just to see the overall credit levels sort of starting to contract means that we're at least starting off our recovery from a good base. We certainly don't want a credit-led recovery, because those things tend to be very fleeting and end in tears. Ask to buy. If you have credit-led growth, it really doesn't end well.
We'll get into the buy saga just now. Looking at money supply as well, breaking to 2.7% from 4% the previous month. Really just an indication that obviously there's just not that much credit available either.
Exactly. The credit is not available, and the lower money supply growth is also disinflationary, which again is something that we do need. There's a lot of cost pressures coming through in the economy, and the last thing we need is to have an excess money supply chasing those high costs, which is one of the reasons why inflation is up there. So again, it's I think a more positive figure for the recovery, not necessarily for the current conditions.
I know you were saying that we shouldn't be building recovery on credit, but do you think perhaps that we should be seeing another interest rate cut to try and boost the consumer into going and obviously getting this credit?
Something one also needs to look at the other side of that, and that's the saving side of it. In the
extra
sense
money
that
every month.
The point is that without savings, you then rely on too much credit again for your growth, etc. Monetary policy does need to balance the savings, because without savings, you do not have the resources to buy the growth. In other words, the investment resources, to actually fuel your recovery. Growth is something that you buy, and you have to have resources to buy that growth. And low interest rates are not necessarily a solution to growth. We've seen this with Japan, almost a decade of virtually zero interest rates, and they have not got a recovery from them. And so you have to actually deal with the other issues, not just look at interest rates.
Dubai, quite interesting. We know that they're going to be restructuring $26 billion of its $59 billion that it has in debt.
Yes.
And we know that the UAE has now obviously souped up its banks as well in terms of extra liquidity, but we know that they're also not going to be backing up Dubai World, and Dubai government has actually said that they won't be bailing out Dubai World either.
No, and I think that probably is correct, but it's that there is in fact a downside to to taking risk. One has to consider that, but no backout, but they will be getting assistance to keep servicing that debt. And
surely if Dubai will defaults, it'll be far more costly than if Dubai actually steps in and bails out Dubai World.
There's a number of thinking of that, because if Dubai World does cave in and you see another round, that ricochets around the world, will the oil price go down, and that's more expensive ultimately for the region than just bailing it out. But I think the cost of the cost of a bailout is also extremely expensive, because it could actually leave the Dubai economy crippled for a very long time as you try and actually lead these lame ducks, in fact, or dead ducks, through a period to try and rescue something that's probably dead.
Chris, when the crisis started last year, when things really got bad, did you expect to see some kind of sovereign default at some stage?
Yeah, the measures that people take.
So you still expect this to happen at some point?
Well, let's put it this way: Dubai is small fry. Okay, there's other bigger fry like the UK and Japan and even the US that their policies are heading ultimately to a sovereign default. It will take place at some stage if they continue along policy paths that they've gone. It's as simple as that. You just cannot keep piling on debt, right, and think that the state has got an infinite capacity to take on debt. It wouldn't be the first sovereign default we've seen in history, but there's bigger fish that could be concerned. And I think a lot of people are worried about Japan, government debt to GDP ratio, well over 200% now. The only thing that's, in a sense, been their saving grace is that the servicing costs, the interest rates on that debt is actually quite low. And they are effectively a surplus nation. So in other words, the debt is owed to themselves. So if the state defaults, it's to their own citizens. It wouldn't necessarily have too much external implication. The concern is when you're ramping up your debt, and again, when you look at government finances, it's not necessarily what's on balance sheet, it's what's off balance sheet that is actually the bigger concern. In other words, what have governments promised? And I saw a table, I think, just the other day, which shows how the actual, if you let me call them actuarial or GARP deficits or liabilities, quite a bit higher, like multiples of 5-6 times of what the ostensible debt is that these governments are carrying, and that's the bigger concern over the longer term.